In today's video, I would like to dive into the key aspects of the proposed tax reforms and their potential impact on you as a taxpayer. So one of the things that I would like to discuss in this video is the extension of the 2017 Tax Cuts and Jobs Act that was introduced to us in 2017, and it brought significant changes to the US tax code and obviously to the taxpayers as well. However, they are to be expired at the end of the 2025. So now that the President Trump is taking an office in January, one of the things that he will be doing and one of the things that's in his agenda is to push this for the extension, and he is also looking to make this permanent. So whether you was pro-Trump, against Trump, none of this matter. It doesn't matter what was your political party affiliation. What matters is knowing that who is going to come into the office and what are the provisions, the rules, what are they going to be implementing. So in today's video, I would like to go over these provisions and dive deep and illustrate you how it's going to impact you. I have put together two case studies. One is for the family with two kids. They don't have any business. They're just simply working and receiving their W-2. And then the second case study is for the person who does have a business. So, and then you can see and understand how it's going to affect you personally, and then what you can start doing to take advantage of these situations, of these provisions, so you can start saving your hard-earned money and creating this financial freedom that you've been working so hard for. In the first illustration, consider the following. I have put together this table. This is a family, a husband and wife. They're filing jointly with two kids. So let's consider that their household income is $200,000. As you can see, there's two columns. The first column shows that if the provisions to be in effect, that the extension takes in effect, and the right column shows that the same situation, income for the same family with $200,000, but how it will affect them if these provisions to expire. So as you see with the provision, if it still takes an effect and the extension is on, the standard deduction is allowed for the family of 4 people is $30,000. However, on the right column, you see the standard deduction is $16,700. So you can already see that you can deduct less. That means that you have to be paying more taxes. So we don't want this. So we like this extension and we like this provision. Then we're moving to the next section. It's the personal exemptions. With this provision, there is no personal exemptions. It was eliminated because what they did is that they boosted up the standard deduction and they took the personal exemptions. And then without the provision, if the provision will be taken out, then the individual would be able to take $5,300 in extra deduction per person. In a way, it's a good thing. And now if you look at the second column, especially if there is a family of 4 people, that means it's going to be $21,200. So we take $5,300 per person, multiply by 4 people, that comes out to $21,200. So, which is great. But let's go forward so this way we can see what's happening next. Now, if you look at the first column, the taxable income comes out to $170,000 for this family. So there's $200,000 in income minus $30,000 in standard deduction. There is nothing else that they can deduct. So the taxable income comes to be $170,000, and that becomes the tax liability of $29,000. On the right column, however, we take the same $200,000 in income minus $16,700 in standard deduction, minus the $21,200 for the exemption for 4 people. The taxable income comes out to be $162,100. And if you start comparing, then yeah, the taxable income is less versus with the extension, where the taxable income is $170,000. However, even though the income is less and we're deducting more, that family will still be paying more taxes. They will be paying $32,000 in taxes comparing to the extension, which is $29,000. And you're probably thinking, how come if my income is less, why do I have to be paying more taxes? Well, there's another thing that was in this Job Act is the tax table. So I actually have put together the tax table for you so you can see. This provision, the tax table, the tax brackets were lowered. So it was less than without the provision. And I have put this illustration for you so you can actually see. So the first, with the provision in effect, the income up to $11,925 is taxable with 10%. Without the provision, the income up to $9,875 is taxable with 10%. And then we're going further. You see, the income between $11,926 to $48,475 is taxable at 12%. However, the income between $9,875 to $40,125 is taxed at 15%. And then the next bracket is 25%, 28, comparing to 22, 24. So even though some of the deductions were taken, as we recapped about these personal tax exemptions, however, the tax brackets were lowered. That meant that, yes, even though your income might be slightly higher, but you're still paying less taxes. And that clearly shows you in this example that on $170,000, with the tax bracket being lower, this family is only paying $29,000 versus $32,000. So that's a $3,000 of savings that goes to this family in their bank accounts. So let's actually go a little bit further now. There was another thing that was introduced in these provisions is the child tax credit. So the child tax credit was, with the provision, it was boosted up to $2,000 per each child. So as you can see, since this family has 2 children, then they can take this tax deduction. This actually, no, correction, it's not a tax deduction. It's a tax credit of $4,000. So meaning, if the tax liability came out to be $29,000 and the credit is $4,000, then they're only paying in taxes $25,000. Without the provision, the credit was $1,000 per child. So now you can see if the tax liability is $32,000, with the 2 children, it comes out the child tax credit of $2,000, then the total tax due is $30,000. So now you can clearly see in this illustration that with the new provisions, this family will be saving $5,000. That means that they'll have more of their money in their pockets versus if the provisions will be taken away. And I'm Ella Rivkin. For over 26 years, I've been preparing tax returns, personal business, and working with thousands of clients. And these past 4 years, when these provisions, when this Tax Cut Job Act came into the effect, there was a lot of confusion going on. And I heard a lot, because people were focusing on what was taken away from them, these personal exemptions, these deductions. But on the other hand, it's not about focusing on what's taken away, it's what actually was given to us and how we can take advantage of that. And then you can clearly see in this illustration how simple family of 4 people just working and receiving their salary, saving this hard-earned money and keeping more of their money. In the second illustration, in the second case study, I would like to share a lady who is single and she has her own business. And if you are one of those who have a business, it doesn't matter at this point if you're single or married. I mean, I just chose it to be single. So I would like to show you how this Tax Cuts and Jobs Act will affect this particular lady if the extension will take an effect or if this provision will be taken out. So let's assume that this lady, she has a business. It's a S corporation. And then at the same time, she has 3 different rental properties. So her salary is 250,000, and then her rental income will be 150,000. So let's assume that she has 400,000 in income. All of this is just for illustration purposes. It's in no way for you to consider what is it it's going to be for you. So if you would like to know exactly how it's going to affect you in your particular situation, in your personal, your business, then I would suggest for you to contact and schedule sessions with your accountants, or if you would like to schedule one with us, you're welcome to do so as well. All right, so let's consider these two different examples. So the first example will show us what will be the implications, the consequences, if the provisions being extended and we're still taking advantage of them. And if the second column, example B, will show if the provisions will be taken out and how it's going to impact that lady. So as I mentioned, she has a 400,000 in income. So she has a standard deduction of 15,000 because she's single. Because she has her own business, and I really love this one. Listen to this one. Because she has her own business, and you remember we said that she has a 150,000 in income from her business. Then there is an extra deduction that is available for the business owners, which is called qualified business income deduction. And it allows you to deduct 20% of that income. So what it means is, since her income is 150,000, then we'll take 20% out of that. So it comes out to $30,000, an extra deduction that now she can deduct from her taxable income. Having said that, we take 400,000 minus 15,000 in standard deduction, assuming that she doesn't have anything else. Yes, there is no personal exemption, as we covered in the prior case study, because that was taken away. However, she has this QBI deduction of 30,000, and then her taxable income comes to be $355,000 with the estimated tax liability of 100,000. Now let's go towards to the right column, the same assumption, but with the, let's say, the provisions are taken away, they're no longer in effect. We take the same 400,000. The standard deduction is much lower, which is $8,350. Yes, she does get that personal exemption, $5,300. But you see, there is no QBI deduction. She's not getting any. So then her taxable income becomes $386,350. And it's not only that it's much higher, but remember we discussed that the tax bracket is much higher as well. Then her tax liability comes out to be $120,000. So clearly you can see in these both illustrations, with this provision still being in effect, this lady is going to be saving $20,000 in taxes in just 1 year without doing absolutely nothing, just taking advantage of these provisions. So the bottom line is staying informed about these provisions and the upcoming changes is very essential for the effective tax planning and your financial well-being. So I would strongly suggest is to consult with your tax professionals and see how it can help you to navigate these developments that are coming up, and then how you can optimize your deductions and take advantage of all these different financial strategies. And if you would like us to help you or to review your tax returns or your financial situation, then please schedule a strategy session with us. And remember, it's all in your hands. Thank you for watching. And if you would like to learn more about what's coming up, as I only shared with you just one of the changes that coming up to us with our new president, there's much more coming up, then please subscribe to my channel and then stay tuned for more videos. Thank you so much for watching.